How's it going, fellow traders? Just a quick note, there are a couple parts to this video. I forgot one part, so I recorded it and added it at the end. But just to give you a little heads up as the intro, make sure you check it out all the way to the end to see all the details of what I promised to lay out. And as always, I appreciate it. Hello, fellow traders. Welcome to the channel. If you're just now finding me, I appreciate you coming across this channel, and I would love it if you would leave a subscribe and like on the video if you find any useful information, and also be sure to share it with your friends. I'm really trying to help grow the channel. To all of you who have been with me already, I appreciate all the follows, but let's go ahead and get into the main meat and potatoes of the video. Basically, what I've chosen to do is I've done a little bit of kind of reassessment of some old scalping strategies, some old ideas, and just in general a few other things in statistics. And there is kind of one anomaly that I was just introduced to pretty much that I don't think most people realize, but I'm going to go ahead and explain here. And I'm going to go ahead and kind of prove this theory with a new account. But basically, we all know about the coin toss. The coin toss is usually a 50-50 game. It doesn't matter how often or how many different times you flip it. More often than not, it's going to come out pretty close to 50-50. So that means for every 100 trades, we should get 50 winners and 50 losers. So that's what I'm going to be using to try to make these trades. But let's say, for example, in this analogy, if I told you the game is always going to end in 50-50, and for every time we flip this coin, if it lands on heads, you win $10. But every time it lands on tails, I get $5. So now we start playing the game, because of course you would definitely play that game. You're going to lose half the time, but you're going to win half the time, and you're going to win $10 every time I flip heads, and you're going to lose $5 every time it hits tails. So we go on along and play the game, and right off the bat, we get basically 11 tails. So at that point, if we get 11 tails, that means you've already, right away, lost $55. Would you still want to continue playing the game? More than likely, most people would say no. But what we've already forgotten by the time we get to this point, because we've experienced the pain, we forget that the game always concludes in 50-50. So that's one of the kind of eye-opening analogies that I'm looking at, because even if you go ahead and flip that coin yourself, you go ahead and record all of your wins, all of your losses as a heads or tails, you will ultimately come out to maybe 49 wins and 51 losses. But what you're really going to notice if you look at all those numbers is you may have 11 wins in a row, and you could have 15 losses in a row. But it always concludes in 50-50. So at the end, you're going to have 50 losses and 50 wins. It doesn't matter the order of how these appear. They always conclude as 50-50 or pretty close to it. So that's the theory I'm going to prove in this new account that I've got set up. And I'm going to go ahead and introduce basically the whole idea plan of what I'm going to be attempting to do. And I'm just going to simply, if I can figure out the right button to hit, there we go. I'm simply just going to trade each morning on the New York session. I've got 2 pairs picked out that I'm going to trade, and I'm going to risk about 4% of the account. I've got the account set up at $250. I've already Made a brand new account to do this. There have been no trades, no history, nothing, no positions already on, orders, nothing. It's all empty. Very first notification right there where I just opened the account, transfer it to funds. So I'm going to be starting with $250, and I'm going to be using basically about a 50 to 1 margin on the Euro USD and the USD DKK, or the Danish krone. I've picked these two pairs because they have a nice amount of movement across the London and New York sessions. But a lot of times I'm not going to be trading the London session. I might catch it Friday morning sometimes. But for the most part, I'm going to be just trading New York. And I'm going to be taking one, maybe two trades per day. So at that rate, uh, this will keep me from basically doing some flipping back and forth or trying to take too small of a trade. It will also kind of limit what I can do, so I'm not going to be firing off 5 or 6 trades in a short 2-hour period. And the whole strategy of what I'm going to use is I'm going to use some past things that I've taught on the channel to make entry. One of the primary things I'm going to be looking at, and I haven't quite done a video about yet, is I'm going to be more or less considering the Dow Jones Theory across multiple time frames. And basically, the Dow Jones Theory, some of you should be familiar with. It's basically where you have the market moving. It's making a higher high, a higher low, a higher high, a higher low, a higher high, a higher low, a higher high, and now we're making a lower high. And if we come back and make a lower, or a lower low, sorry, and then if we come back up and we make a lower high, then now, according to Dow Jones Theory, we've had a reversal and we could be going short. So I'm going to be looking at that across probably the daily, 4-hour, 1-hour time frames. Might even be looking at the 15-minute time frame. And basically what I want to be doing is I want to take these tools, which I'll go over in just a moment, and try to trade in the direction of the Dow Jones Theory knowledge. So for here, I might have been long, but now we're coming back. I may have been stopped out. I'm going to be using stops in this. But now at this point, what I would do is I would wait for price to come back up, and then I may look to go short. And I'm going to be looking across two pairs that are not extremely correlated, but the main idea is to try to dodge this correlation so that I'm not actually doubling up in one way or the other. I'm only going to be trading one pair at a time because of the margin, but I'm basically going to be maxing out the margin. For the Euro USD at 50 to 1, I can buy as much as 0.11. And for the Danish krone, I can buy the same amount there, but I'm also working with a little bit different pip variances. This would be 150 pips in this blue circle, whereas this is only about 11 pips in this blue set of lines. So big difference in the movement and pip value. So but it does move 300 to 400 pips on the ATR, showing a 300 or a 100 right there. So this is one of the things I have to kind of account for in the calculation. So I'm going to be using the risk calculator that I have listed on my profile, and I'm gonna be setting that up for the stop size that I want to use and try to keep it somewhere in the range of risking about 4%. I've got the risk calculator set up to be percent based at 4%, starting with 250. And the way I'm going to do this is if I lose, there's a phenomenon where if you go down in account size and you also go down in your trade size, you have to win more in order to get back ahead. And that is a statistical improbability and impossibility. It's just not going to happen. So in order to counteract that phenomenon, I'm going to say right now this stop would be $8.47, $8.50. So if I lose this trade, my account will go down to 242 and the risk may drop down to like 780. But if we start following that pattern of dropping down, of course we're going for a 2 to 1 or so. We're going to need more forward progress, which we're probably not going to get because of the law of 50-50. Then we're going to end up not making up our forward progress. So I'm just going to say, instead of risking that $7.80 or whatever, I'm going to stay with the 850 or so, roughly, risk on the next trade. Then once I finally win and bring it back up, the statistics will actually have to be balanced a little bit for me to assess this, but as I come back ahead and the equity goes up, then this stop size value will increase even more from the $10 or so that I'm looking to actually risk to actually end up risking probably $10, $50, $11 as the account grows. So eventually, if I get up to risking $15 per trade, every loss in a row is going to be risking 15 a piece. And what I'm planning to do and how I'm calculating these sizes and the risk amount, I would say 4% is about the max you want to do. Because if you lose 15 times in a row and you lose, say, $10 each time, well, that's $150. You still have to be able to open up and risk that same amount. So I may actually be just slightly high. I may have to drop down to about a 3%. I'm going to double check this one more time, just kind of look at it. I know this is what I can get the most size out of to begin with, but I'm probably going to have to go a little bit lower percentage risk to make sure that my margin can handle this amount lost. And the whole idea of thinking is when you're taking drawdown, your account has to be big enough to hold the drawdown plus leave some room to work. If you don't have this room to work, you're trapped, you're stuck, you're liquidated, you're blowing the account. So as long as you can handle this drawdown in the way that I've been showing in previous videos, then you can make any trade you want, adding in here, adding in here, adding down here, adding down here. You can add in as much as you want to catch that trade at a reasonable extent. But the same theory is also going to apply here. Instead of having drawdowns that we have to contain, we're going to have to contain these loss streaks and still be able to have room down here to open a new position. So that position is going to have to be able to create the same amount of risk as each one of these trades has lost. So if we're risking $8, $7, which is what I'm thinking more or less I want to go with, I'm thinking I want to just risk $8, because if I lose 10 times, that's $80. I mean, if I lose about 15 times, that's going to be 120. And that's about half the account. And at $120, I can open up a 0.06 with the margin that I have. So if I'm looking around that range or so, then I'm going to need to go about a 2% risk. But I'm going to kind of gauge it and just use a little bit of a dollar amount. But the same idea is going to apply. And the reason being is I can hold $120 in this loss column. I'm sorry, figuring that out on the spot. Kind of still weighing the numbers a little bit, but I've got pretty close. But I'm going to try to use a 0.6 or whatever I can to try to get that same $8 of risk on each trade until the account moves up. If it goes down, I'm going to have to risk $8 here, $8 here, $8 here, and then eventually once it goes up, once we cross over the zero line where we started, now we're looking at $8.25, $8.50, $9 as we go up. So if we go up here and it's $8.50, we go back down, we go back down, we go back down, we go back down. It's $8.50 every time till we get here. Then we're at $9. And that's how I'm going to continue to push this account up and use the statistics and stay in line with the 50-50 of the statistics. Now, as far as the assessments go and how we're going to look at this account and judge its performance, it should match what's on paper. If it does not, then it is not worthy of judgment. Now, what do I mean by that? Well, we know that the coin toss, if we flip 20 coins, or 20 times, it should be 10 on one side and 10 on the other, right? That's 50-50. So if we flip this coin 20 times, we take 20 trades, and I have, say for example, 9 wins and 11 losses. That's another example of where we could, trying to figure out the numbers I had used to explain this to someone else already. So same thing, a little variance is going to occur. That's an acceptable way to look at it. But if we have taken 20 trades and we have won 15 or let's say 16 of those and we've lost 4, we cannot, absolutely cannot assess this as performance. We cannot assess any of these trades as money in our pocket, because the same rule applies as when we're on drawdown. Just because we're in drawdown, it's just like the example I showed you. You know, you lost $55 right from the start. Right here, let's say, for example, we lose $64 right from the start. That is the same as counting 16 wins in a row and 4 losses. That is not a proper assessment, and that does not determine whether or not we continue or don't. This account being blown constitutes we do not continue, and this account will allow for me to lose approximately 15 to 20 times in a row and still have enough to open the same risk position. So that's going to be the whole principle behind it. Now, if later on we lose another 10 in a row and come out to where we now have a situation where we have taken, say for example, 30 trades at this point. Let me make this a little bigger so we can see it. So now we still have, like, say for example, 17 wins. We won once, but we ended up getting 9 in a row wrong, and we end up having 13. Well, that's kind of a little bit closer to being able to say, okay, we made X number of dollars so far, and this is our profit. But over here, we can't say we won a bunch of money, because then what's going to happen is we're going to size up or take it out, and then we're going to come down here, and that's it for our account. We're either going to do that, or we're going to end up going backwards. We're going to have to size down, and that's going to cause the phenomenon where we go up, never break past the height, never break past the height, and boom, down we go. So that's how we're going to avoid all this. We are not going to assess the account unless it is somewhere near that 50-50 range. If it is not within 2 to 3% of 50-50, you cannot assess the performance. It will lie to you. Be it on the positive side or the negative side, the lie is equally as bad. We have to be near 50-50. Now, I'm expecting a 50-50 hit rate. I'm also expecting to win about half the time. I'm going for a 2 to 1. So that means in 20 trades, I should be able to make 20 times the risk, because I'll get 1 R out of a 2R win to cover out those ones that I lose. And what's left is my 1R times 20 to make a final result of 20R. And when we have 20 trades, if 10 win, 10 lose, I should still have 20 times whatever I choose to risk, or $160 of profit if I'm risking $8 and growing slightly as we go. So this is the expected outcome on paper, and if we do not have a 50-50 situation by the time we hit 20, we look for a 50-50 situation as soon as we can before we get to 30, and then we can actually assess its performance. Any other time, no. And that's how the statistics actually work, to where it's actually on paper the same as what you're getting out of your account. So as long as we can hold the losing streak and still open the same size position to go up or down, however we're going to trade that next trade at the same amount of risk, then we have a viable strategy. We have a viable risk management strategy. So that's how we're going to handle all of this and take it from there. So what I'm going to actually do now at this point is actually record my trades daily. I'm going to come in at New York. I'm going to look at the euro and the Danish krone, and from there I'm going to decide to make 1 or 2 trades. If I lose the first one, I may sit and watch and later on see if there is another opportunity. If not, then 1 trade for the day, 1 trade, 1 loss is all I'm going to do. I'm not going to pick long, then go short, then go long, then go short, because of what this 5-minute pattern said or what this level looks like or whichever. I'm just picking one choice, taking the win or loss, and moving on for the day. It kind of depends on where we go with the market. Sometimes you may get a couple of chances, a couple of opportunities to try. But generally in some sessions, a lot of times in New York, you get 1 move. And if you're looking at London only, you get 1 move. So I'm just going to kind of look. There's 2 moves possibly there, so I could choose to take out profit on that, sit and watch, and go back in. But that's also, something that happened on a Tuesday, not a Friday. But what it does today, we could, expect it to do again tomorrow, or something else that it's already done in the past. It just keeps repeating itself over and over again. But we keep getting the same pattern of number of moves, so that's the determination for how many trades I'm going to take. So I'm going to go ahead and wrap this up before I ramble on forever. But I'm going to post the progress. That's all the theory behind what I'm planning. And I've given the account starting points. We're going to go from there. And after that, we're going to assess the results when the win and loss is balanced. So we have to make sure we can shoulder these streaks, positive or negative. Otherwise, the account blows and we give up for nothing. So I'm not looking to take that route. I'm just looking to make money and give this a full test thoroughly to see exactly what we can do in terms of trading statistically and not dollar cost averagingly. So I will catch you guys on the next video. Be sure to like, subscribe, share with your friends, leave comments. If it's helping you out, let me know. But for now, I'm going to go ahead and wrap this up, and I'll catch you on the next one. I'll keep recording what I do and fill you in as we go, but only at proper assessment points like we talked about. So till next time. Okay, to take a look at what tools I'm going to be using, just as a little bonus into the video, I did not mention this before I closed out. I am going to be looking at the 13 selected videos to use mostly as what I'm trading with. The most common technique I'm going to be using and looking at is going to be the levels from thin air, and support and resistance is not subjective. But I'm also going to be using some of these particular nuances as I go along. I'm going to be looking at the way I show trading in the live series in full trade, start to finish. I'm going to be looking at doing it also the same as Stop Being Complicated, the only trading video you need. That's going to be kind of the brunt of everything. I'm going to be using the 5-minute chart and kind of looking at the 2-candle strategy setup that I discussed here. I'm also going to be applying kind of a trade entry method such as the blitz trade method, where I'm going to be taking a more of a shallow stop and try to catch a little bit longer, a little bit more of the move, but I'm going to be reasonable with it. I'm going to be probably about between 5 and 10 pips on the euro, and probably somewhere around 100 to 150 pips on the krone. I'm not going to be doing any of the correlation or anything, but I'm also going to be looking at the step pattern that I use in the how to trade full simple trading strategy and the grow a $100 account fast. So that'll be one of the other entries, and I'm going to also be using the somewhat of the price setups a little bit, as well as mostly kind of discretionary trades, part 1 and 2. I'll be taking a look at using those. And last but not least, that Dow Jones Theory that I kind of laid out. And I'm also going to be considering the news, which I need to get a video out about. And it basically kind of demystifies what this price scale really means, is going to be the focus of that. So stay tuned, subscribe, and follow me for more. Let me go ahead and end this here now for real, and I will see you guys in the future.